What causes the crypto market to pump or dump? In short, it's crypto-specific factors and macro factors. If you know what these are, then you can predict crypto prices with surprising accuracy. This begs the question of which crypto and macro factors are coming up in 2024 and how they could affect the market. A recent report answers all of these questions, as well as a few important predictions. That's why today we're going to summarize this report and tell you what it could mean for the crypto market. Don't go anywhere. The report that we'll be summarizing today is titled Outlook 2024. It was published by crypto research and investment firm CoinShares late last month, and we'll leave a link to the full report in the description if you're interested. Now, the first part of the report unpacks the effects that various macro factors could have on BTC's price over the next 12 months. The authors start by talking about what is arguably a crypto-specific factor, and that is the approval of the spot Bitcoin ETFs. They note that the inflows could take BTC to 60K this year. That said, one could argue that the approval of the spot Bitcoin ETFs is a macro factor because it makes BTC more correlated to other macro factors. That's simply because it makes BTC more accessible to institutional investors who often adjust their portfolios in response to things like interest rates. As we mentioned in our video about BTC's price after the spot Bitcoin ETF approval, BTC's price action will therefore depend on how these institutional investors see BTC as an asset. In this case, the authors imply that institutional investors see BTC as a safe haven asset, comparable to gold, which makes sense. There is just one caveat that the authors underscore, and that is that institutional investors love safe haven assets that earn a yield, namely US Treasuries. In practical terms, this means that BTC and gold will compete with US Treasuries for institutional inflows and will only win if the Fed lowers interest rates. Newsflash, but the Fed is expected to lower interest rates significantly this year. Logically, this will increase institutional preference for BTC and gold over Treasuries, which will be bullish for both assets. However, interest rates aren't the only macro factor at play. The US dollar is another related factor. As some of you will know, BTC's price is inversely correlated to the US dollar, as measured by the DXY. In plain English, when the US dollar gets stronger relative to other currencies, then BTC's price goes down, and vice versa. However, the authors noted something odd. The correlation has been positive lately. In other words, BTC has been rising alongside the US dollar. The authors seem to take this as additional evidence that BTC is seen as a safe haven asset. But it could just as easily be due to the hype around the spot Bitcoin ETF approval. Regardless, the authors believe that this correlation will invert again in 2024. Assuming the US dollar weakens, then this will be bullish for BTC. The caveat here is the DXY. Again, the DXY measures the strength of the US dollar relative to other currencies, namely the euro and the yen. If the euro, the yen, and the US dollar all weaken, but the euro and the yen weaken more, then the DXY could still rise. As you can see, there's a lot of nuance here, but that's macro for you. By the way, if you're enjoying the video so far, then be sure to smash that like button and give it a boost. This ties in to the second part of the report, which analyzes how macro factors could affect crypto-related stocks. The authors start by highlighting the fact that the US economy has been surprisingly resilient despite the meteoric rise in interest rates. GDP figures remain robust, as does the unemployment rate. They then recap how Fed Chairman Jerome Powell suddenly became dovish last December. That is, giving signals that the Fed is going to start lowering interest rates. They note that the exception of rate cuts caused by Jerome's comments have been the primary contributor to the market rally we've seen since. However, the authors imply that the coast isn't clear just yet. That's because a lot of companies, including crypto companies, have lots of debt that they need to refinance this year. The authors estimate that around a quarter of publicly traded crypto companies will need to refinance debts over the next 3 years. Assuming interest rates stay higher than investors expect, these companies could be forced to refinance at interest rates approaching double digits. Obviously, this expensive debt could squeeze crypto companies while simultaneously lowering the yields they're currently earning on their cash reserves. Cash reserves are typically held in short-term US government debt, by the way. Anyways, the authors highlight 2 risks that crypto stock investors need to be on the lookout for. The first is the possibility of a recession, and the second is a resurgence in inflation. The former would result in significant economic weakness, while the latter would result in interest rates staying higher for longer. The authors believe there is a real risk of recession because it takes between 12 and 18 months for interest rates to affect the economy. They note that the last rate hike happened last summer, which means that the effects of the Fed rate hikes may only start coming into play in the coming months. Similarly, the authors believe that there is a real risk of inflation if the Fed cuts interest rates too soon. They note that this would cause commodity prices to surge and reignite consumer spending, which would force the Fed to restart its hiking cycle. That is, continuing to raise interest rates higher. What the authors fail to note is that it would likely take time for this inflation to reappear in the official data. Put differently, the Fed cutting rates too soon could be extremely bullish for the markets in the short term. That's because there would be a sort of window where rates stay low and liquidity rises. Given that crypto appears to be sensitive to liquidity, aka money supply, it would be the first to rally, and history suggests that it would rally a lot. If investors are correct in their interest rate forecasts, then this rally could come soon. If you want to make sure you're ready for it, by the way, then check out the Coin Bureau Deals page. It's got trading fee discounts of up to 60% and sign-up bonuses of up to $50,000 on the best crypto exchanges. These deals are only available to viewers of the channel and for a limited time only, so be sure to take advantage of them ASAP. The link is down in the description. Anyways, the third part of this report pertains to an extremely important topic that's been completely under the radar, and that is Bitcoin mining. For context, Bitcoin's hash rate, that is the amount of computing power being used to secure the Bitcoin network, has historically been correlated to BTC's price. Like BTC, Bitcoin mining follows a cycle consisting of various phases. In the case of Bitcoin mining, the authors outline 4. The gold rush, which is when BTC's price is rising, the inventory flush, when BTC's price is falling, the shakeout, when BTC's price collapses, and the rebalancing, when BTC stabilizes. Each of these 4 cycles has a corresponding effect on hash rate. During the gold rush, BTC's hash rate rises. During the inventory flush, it falls. During the shakeout, it collapses. And during the rebalancing, it likewise stabilizes. What's strange is that Bitcoin's hash rate has basically been up only since mid-2021. As far as the authors are concerned, though, they believe the shakeout phase occurred in late 2022, and that 2023 was the rebalancing phase. They seem to acknowledge that this is a bit strange, as the upcoming halving could increase the cost to the point that it takes, and I quote, quite a few big miners offline. For reference, the Bitcoin halving cuts the amount of BTC rewards to miners in each block by 50% every 4 years. The next halving is due sometime in April, and there's growing speculation that this could have a serious impact on miner profitability. From the author's perspective, this could cause the Bitcoin mining cycle to stay in the rebalancing phase until sometime after the halving, and the gold rush phase should begin at the end of this year. This would be consistent with past crypto cycles and set the stage for a blow-off top in BTC's price. This relates to the 4th part of this report, which is about the Bitcoin mempool. For those unfamiliar, the mempool stores pending BTC transactions. miners select transactions from the mempool based on the fees associated with them. The higher the fee, the faster the transaction gets included in a block. In the past, miners would start by processing the transactions with the highest fees in the mempool and work their way down until they've processed all the pending transactions. In the present, however, there are so many pending transactions that the mempool is constantly full, resulting in very high fees. The authors note that this has never happened before, at least not for such a sustained period. Of course, it's all due